moved from a simple economy where there was just bank deposits and, as you rightly said, real estate and some gold. Gold was not an investment in those days. It was sort of India's fallback for a rainy day, and mostly it was in ornament form and not really as part of a portfolio.
I think perhaps India is the richest country today because of gold assets of all its citizens and whatever we hold.
Let me just illustrate this by a parallel to a high-speed highway, where I think everybody is moving at very high speed. In the absence of proper traffic regulations and road rules, it's going to end in a complete mess.
Yes.
It's going to end in a disaster, whether it's a high-speed highway or airspace. Whereas this growth is comparable to that. There are no guardrails that can control this growth, keep this growth safe. This will end in disaster. So government is a very key stakeholder in this because they want to keep the capital market safe for everybody to access it. They want to make sure that a good level of what we call democratization of access. They want all the relevant people to have the opportunity of access to capital markets and participate in the growth.
Hi Kishan, it's been wonderful to catch up with you, and it's been almost 35 years in the industry. And after our IIM days, I always went into sales, marketing, and later on branched out into technology and deep tech. And I've always been an investor, while you actually branched out into the mutual fund industry, and you always been financial investment domain. So it will be very interesting to know how you see this financial investment domain shaping up over all these years. I remember those days, most of us, we used to maximum invest, or our parents used to invest in, NSEs or post office or some fixed deposit with very high interest rates, and everything was manual. If you lose the paper, you're gone. Then we started getting exposed to the share markets, and some people made a killing by investing in Dr. Reddy's at a maybe under sub 100. And we used to be always in awe of such people. But now the choice is tremendous, and it's been evolving such a rapid pace, and it's only getting more and more complex, faster and faster. So it will be very interesting to know your experiences and what you see and how you foresee this shaping up.
Thank you for setting the stage, Srini, and nice catching up with you as always. My own entry into the mutual fund space was rather accidental. As most of us did, we selected what looked like a good opening out of campus, and that it took me to SBI Capital Markets, which was an investment bank as well as the parent for the mutual fund business, which at that time was a fledgling business for SBI. And I got posted into the mutual fund arm of SBI without really anticipating or expecting it. And at that time, the industry was in its inceptual stages, and with UTI, which was not really a mutual fund, but something which worked very close to being a mutual fund. And then there was SBI Mutual Fund and maybe the arm of Canara Bank. Interestingly, there was no SEBI at that time. So the regulation itself was light or in the process of falling into place, and the industry was really small. The industry has really come a long way since then. We now have over 80 lakh crores in MF assets and roughly more than 5 crore investor accounts, 5 odd crores investor accounts, which roughly represents 1 in about 5 or 6 Indian households have a mutual fund account, roughly speaking. But on the other hand, this represents, MF assets represent about a third or less than a third of the GDP of India, or thereabouts, and about a third of the bank deposits in the country. In the US, that number stands at some 120 or 130%. And it's not just mutual funds. Pension funds constitute a very large part of the investment landscape in the US. In India, that is also small. NPS is less than 20 lakh crores now. And finally, we now have much more sophisticated products as well, which have grown at very high pace in the last 10 to 12 years. The alternate investment space is estimated to have 20 to 25 lakh crores between various AIFs and the PMS sort of structures. So we have a landscape which is incredibly complex as compared to what we had in 1990. You're right, the concept of intermediation had not yet taken root so much in 1990. So we had rudimentary savings products or avenues at that time, and which went banks. And in the big picture, let me just try to explain where these products fit in alongside banks. Both banks and the MFs channel savings from ordinary people like us and households into productive economy. In the case of banks, the linkage between the mobilization of those savings and the deployment of those savings is not direct. In other words, banks take deposits at a certain contractual understanding or agreement or rates from households and from depositors.
Yeah.
But then depositors have nothing to do, broadly speaking, with how those funds are deployed. The banks, in turn, lend it to the economy broadly. And this is a regulated business. And because these two activities are de-linked, households or depositors get a fixed return, a predetermined, fixed, but relatively safe returns on what their savings, on their savings. In the case of products such as mutual funds and even pension funds and other products, where we see disintermediation happening, there is a direct linkage between what funds are collected and where they are deployed. In other words, the savings that are mobilized go into specific assets, and broadly speaking, the return generated by those assets flow back to the depositors, to the savers. And so the cost of this intermediation is lower, and therefore the returns tend to be higher. This is the broad hypothesis. But having said that, the products other than the bank deposits, such as mutual funds and alternate products, and various other products that have come into the market now, there are InvITs, which also form part of the alternate space, real estate funds. All of them are specialized in many ways.
Yeah.
They're also somewhat more risky as against banks. So broadly speaking, banks offer avenues for parking transactional funds, which people need for day-to-day expenses. They also offer some level of safety to people who want that on a certain part of their savings, and depending on their life cycle and preferences, and to meet expenses that people would need in the short to medium term, because you don't want to lock in your savings that is meant for, let's say, use in the next 6 months into any volatile asset class. Whereas when it comes to long-term savings and meeting long-term financial goals and wealth creation and concepts such as intergenerational wealth transfer, which is what wealth management industry addresses for relatively well-to-do, you need a sophisticated bouquet of products to meet investor objectives. So this is the sort of landscape evolution. So in terms of size, scope, sophistication, regulation, and the reach, the industry is way bigger than where we started in 1990. It's way more sophisticated, and it's also way more interesting and exciting. And the best part is, when we compare with the developed world and where India is, we believe that there is a long way to go. And finally, your area or domain of expertise, technology, is going to enable all this to happen. And it's the backbone which enables every one of these developments to take shape in an efficient manner. So the impact of technology is already very profound. And going forward, it will be one key pillar on which this industry grows.
Awesome. I think that's a fantastic overview of from where we started and how things are progressing. So actually, if you see, I remember, those days, early days when we started our work, we always used to operate in sort of a seller's market. Okay, so everything was only going up. The demand was going up, but always sellers had the last laugh. So the prices were always going up. The returns were always high. So those days, economies could sustain committed high returns to investors, whether it is in fixed deposit or investment in stock market was also mostly supposed to be very, very high yielding. And I think the concept of alternates, in my opinion, also as we have seen it shifting. For example, in our early days, in early 90s, stock market was an alternate investment. Later, mutual funds was an alternate investment. Then perhaps real estate and gold were traditional investments. But nowadays, if you see, because of technology started getting more and more used and dematerialization started happening, it becomes easier to transfer stuff. At the same time, cyber attacks are getting more and more sophisticated. So that's where you need to be much more careful, knowledgeable, and also adopt latest possible systems, and the choice that is being offered, and the way you need to monitor whatever your portfolio is, how it is shaping up, how it is evolving, where the risks are emerging, how you have to restructure. All these things, complexities are going up day by day, right? So that's where I feel government has been conscious of this and trying a lot in terms of putting some method in the madness. They have a lot of systems and structures and technology intervention around these traditional investments, with, of course, launch of SEBI, dematerialization, and regulating so many types of IT platforms, and different types of applications coming out, and everything getting technology enabled. But what we observe is, over a period, the concept of assured return, definite return, high return, that's all becoming past. Like, you can no more assure any return at all, first of all. So the risks are getting more and more embedded into whatever investments are taking place. So that's where government also started getting conscious, and then started looking at perhaps regulating. And investors at the same time are trying to run ahead. They're trying to look at opportunities where they would get more returns. For example, if stock market returns are already discovered, if fixed deposit returns are coming down, where would I get more return? Maybe real estate, maybe some other assets, or startups. Right? So different types. So always you have something new that is emerging, and which seems to be yielding high returns, and suddenly you will find some big scams happening out there, and then a lot of people losing money. And since government did not regulate at that point of time, a lot of people would have gone their hands. So then government again has started looking at this, how to regulate this, how to protect the investors, how to ensure that again there is some method in the madness. So they started coming out with this concept of alternate investments, which a broad category wherein anything that is not coming under the traditional discovered investments, which are properly regulated, they all could fall in alternate investments, and the definitions keeps on changing over a period of time. Of course, globally they are running much farther ahead because of so many developments that are taking place. India is a lot to catch up, as you rightly said. So it will be interesting to see, what are the different types of alternates today available in the market. Alternates in the sense, it could, some of them you already pointed out, like REITs and InvITs, and then alternate investment funds, startup investments, gold, real estate, now crypto also. So if you can throw some light on how this entire domain is moving, it will be very interesting.
So you touched upon a lot of relevant topics in your take on how things have evolved. So you're absolutely right that the definition of what constitutes alternate investments has been changing all the time. Very interesting point that you made, that stock market investing itself was an alternate investment choice 40 years back, or even 35 years back. Not many looked at stock markets as an investment avenue at all. I remember that I think people looked at it as a gambling den, where you speculate. And it took a lot of efforts on the part of the industry and the regulator to kind of educate people that when done in a professional manner, stock market investing is one more legitimate way of wealth creation, and long-term wealth creation and capital formation. So the other interesting point that you made is that the variability in returns. When we had fixed returns that seemed to be on the higher side, there was also lower growth, and the real rate of returns, even though the nominal rates of returns were high, inflation was on the higher side in general in those years, because supply side was constrained. And so the real rates of return were not as high as what the nominal rates suggested. But there was a false feeling of safety for people, because the deposit rates looked high at 10, 12, 14% and so on. But your purchasing power started to get eroded. To illustrate this in a better way, I'll give this interesting anecdote. A Maruti car that I happened to buy in 1998, it was about 3 lakhs. And they gave me a gold coin free along with that. The Maruti car, or an equivalent entry-level car, maybe is now priced at 4 or 5 lakhs. In a span of about nearly 30 years, it's not risen so much. But the gold coin they gave me is 1.5 lakhs today. Okay, yes. And I'm still having it in my locker. I was looking at it, I was stunned, because when I got that, we just put it away saying it's a gift, let it be there. And now it's become something of great value, relative to the price. Now, in a supply-starved economy, this may not have happened. As the economy has become more sophisticated and savings avenues have opened up and growth has accelerated, many new avenues of savings and investments have opened up. And that's the evolutionary story of investments, because we moved from a simple economy where there was just bank deposits and, as you rightly said, real estate and some gold. Gold was not an investment in those days. It was sort of India's fallback for a rainy day, so to speak. And mostly it was in ornament form and not really as part of a portfolio.
I think perhaps India is the richest country today because of gold assets of all its citizens and whatever we hold.
Yeah, households.
Yes.
Yeah, also huge amount of gold in the Indian temples and religious places. So that's a topic for another discussion. But gold, though it was considered a store of value longer term, it was not, nobody calculated as part of their portfolio. In the last 10 or 15 years, it's become, or particularly the last 5 or 7 years, and more so in the last 3 to 5 years, it's crept into the portfolios of people.
Yes.
So you have advisors suggesting that you should have 5% in precious metals, including gold and so on and so forth. So the space has evolved. That's one. And the choice has become much wider and much more meaningful. So now the return variability, which you touched upon, is immense. So the concept of real rate of return, which means, for instance, to illustrate, in the US, if you make 6 or 7% returns, that's a big deal, because inflation is, in general, though it's moved up in recent years, long-term inflation is 3 or 4% or even lower. And so 7% return on a stable currency is something that really creates a lot of value over a long period of time. In India, where inflation has historically been on the higher side, and even now, somewhere between 4 and 6%, and has stayed above 5 to 6% for most of the time, you need 8 or 9 or 10% or more to beat inflation and get you a value. So at the same time, the ability to generate that value is not to be taken for granted. That's the other point which you mentioned, which is that you cannot take any number as granted.
Correct.
Making money is not easy, or getting returns on capital is not easy. And so the concept of risk-adjusted returns comes into play. And what is risk-adjusted returns? It's very simple, that if you are unwilling to take any risk, or you want to get away with minimal amount of risk, then your return will be on the lower side. Then start taking controlled amount of risk, and in a sensible manner, you start to get higher returns with a good trade-off. So the concept here is not that, you go and take maximum risk, right? That often doesn't maximize returns.
Correct.
That destroys capital. The concept here is to take higher risk in a calibrated manner, in a sensible manner, in a manner which you can understand, in a manner which can be measured, which can be quantified, and therefore where outcomes can be measured again. And can be graded. And so in this sort of, spread that you get on risk, return, reward, the spectrum that you get on risk, return, reward is where all these alternates fit in. So alternate investments in general are not for, let's say, the typical middle class or lower income saver, because most alternate investments have a threshold investing minimum, which happens to be on the higher side. Whereas mutual funds, you can access at a minimum of 1,000 rupees, and a few thousand rupees is enough. Now, you cannot get into a PMS at less than 50 lakhs. You cannot get into an AIF at less than 1 crore. And it's also very hard to buy an rate or an InvIT unless there are reasonable size of investments that you can deploy. So it, one, addresses the needs of people who have a relatively higher savings base and surplus capital. And that is as it should be, because these are higher risk investments, and this is therefore not meant for the first time saver or people who have just got to create some savings. These are for people who have already passed that particular phase in life and have gone to the next level of sophistication and requirement. The other point on alternates is that the duration of savings also needs to be a bit longer term. because the spectrum of risk return reward that I alluded to opens up in a favorable manner only if you give it time. So it's very hard to create a risk return reward correlation with a quick in and out
Yes.
on investments. And longer time horizons often give a lot of options and a lot of interesting options. So I take real estate, for instance, and rates. Real estate is a really long-term play.
Yeah.
I mean, there is no day-to-day
Correct.
change in the price of real estate assets. So the underlying asset really multiplies if you choose well, if you have really long horizons.
Yes.
Stock market investment, similarly, given the kind of market we have seen in the last 5 years or so, wherein we have seen stocks priced relatively expensive.
Yes.
As compared to the past. The only way you can get good outcomes is if you telescope and take longer term views and are patient about both buying,
Yes.
in terms of what time to buy, etc., and also in terms of patient holding horizons. So in summary, alternate landscape has developed to address a need.
Yes.
Which is that there are investors out there, and there's statistics available on number of households which are what they call millionaire households nowadays, what they call billionaire households, and so on. There is a number that has been growing exponentially, and it's a meaningful mass now. So there is a need for such investors to access different types of products at different ends of the risk return spectrum. Similarly, the market has opened up to foreign investors.
Yes.
So today the market for Indian assets is not just limited to Indian investors. Foreign investors have accessed India in the last 3 decades, progressively so, through a variety of avenues. But suffice to say that these people have come because they have seen the growth in India and the promise that it holds. But that part of their deployment has also become more sophisticated. They were mostly investing in plain vanilla equity or some government debt in the beginning stages, and increasingly they are into private equity, they are into venture funds, startups, they are into sophisticated debt products, they are now into products such as InvITs and rate kind of structures, and therefore they cover the gamut of investments.
Yes.
So you have a situation where there is a need for different types of investments based on risk and returns. And there is also a catchment of investors which consists of not just domestic households who are relatively well-to-do, but also the foreign funds.
Yes.
Which in themselves are a very wide spectrum.
Correct.
There are sovereign funds and there are individuals who maybe come through some hedge fund structure.
Yes.
So it's an incredibly complex space where this product has a big relevance because it's a need.
Yes.
And there is a demand. And in all this, we should also mention the role of various intermediaries.
Yes.
That space has also become huge. They have a role to play: advisors, service providers, people who provide technology, and so on and so forth. So this is a landscape which was really tiny, has now become huge, and it's set to kind of progress more and more in that direction.
Yeah, fantastic. So actually, it's like a long way to go, but we have been making steady progress. Government also has been coming out with a lot of new regulations and setting up intermediaries also. So actually, as you rightly said, as stock market scams unfolded, and then the need was felt for regulating stock markets and the mutual fund industry. All these industries and everybody started channelizing their personal investment savings from fixed deposits on real estate into all this stock market and mutual fund portfolio management related instruments. So it's a huge industry that has come about. A lot of knowledge has been created. It is being mined, used by professionals, experts to generate that alpha returns for the investors. So the people who are able to understand this risk reward ratio and able to offer better risk adjusted returns, they started doing extremely well, and it's always people now started looking at who are the fund managers, what is their track record, and everything is available. It is out in the domain, right? So the entire traditional investments has been well explored, discovered, but again people hunt for the new alpha return from different domains, undiscovered areas. It's led to investments in angel funds or startups or venture capital or the fractional ownership properties. So, or even, people also started investing in things like art, different forms of investment, and a lot of people investing heavily in crypto. So that's where government said, okay, now we have to put some method in this madness. And then they started regulating one by one, and they started attacking the biggest fish in the water, that is basically the alternate investments funds. So they helped set up this alternate investment fund concept, and categorize the alternate investments into different categories, whether it is the alternate for category 1, category 2, category 3, so that people can, through those investment avenues and through those types of funds, can then participate in the growth of the economy, rather than only through the stock market and the mutual funds and the investments in the banks. So that's where people also could get, investors could get, hold in the pie of this entire spectrum, and this started growing very fast. Now all the traditional financial experts started focusing on this, and now you find most of the big financial companies, wealth management companies, also coming into alternate, setting up their cat 1, cat 2, cat 3 type of funds. Of course, long way to go, because there are many more such investment opportunities which are still not regulated, and maybe they will be regulated in the future, crypto being a classic case. So, and then how you permeate down to lower average segment of the population, that is people who can afford maybe a lakh of rupees as an investment, but still want to get exposed to this high returns that alternate investment could promise, but the risk reward is totally undiscovered, unknown. So if you can throw some light about the government, how it has been evolving this entire strategy around this alternate investment funds, it will be very interesting with your knowledge and experience.
So you touched upon a very, very important part of this whole universe of alternate investments, which is regulation. We need to understand the importance of regulation and why government is very concerned about the need for regulation. It's like, let me just illustrate this by a parallel to a high-speed highway, where I think everybody is moving at very high speed. In the absence of proper traffic regulations and road rules, it's going to end in a complete mess.
Yes.
It's going to end in a disaster, whether it's a high-speed highway or airspace, where I think people travel fast. So whereas this growth is comparable to that, if there are no guardrails that can control this growth, keep this growth safe, this will end in disaster. So government is a very key stakeholder in this, because they want to keep the capital market safe for everybody to access it. They want to make sure that a good level of what we call democratization of access.
Yes.
They want all the relevant people to have the opportunity of access to capital markets and participate in the growth. They do not want an unwanted asymmetry of information, which means they don't want certain people to take advantage of information arbitrage.
Yes.
In a manner where they aggrandize themselves merely because they have access to what is called inside information.
Yeah.
They also want orderly development of the industry. The industry that grows too fast without any controls is also accident prone.
Yes.
And so this is the case in all jurisdictions around the world. The best of developed markets do well because they are very well regulated markets, attract investors from all over.
Yes.
So, for instance, a potential investor from South America, they often don't even know, where India is or what India is all about. Yet they are able to study the prospects of India and then deploy funds into India. In the absence of a well-regulated market, this wouldn't be possible. So, for instance, Africa for us may be perhaps a very attractive investment opportunity in many ways. But most of us wouldn't go there because these are not regulated markets, and therefore your capital can be at huge risk. So the importance of regulation cannot be overstated.
Yes.
The regulatory environment has been evolving. So for alternates, the government has sought to regulate it in several ways. One, because the risk is perceived to be on the higher side.
Yes.
They have put certain limits on minimum limits. And the correlation they are trying to draw is that if somebody is capable of putting 50 lakhs, 1 crore or more, in general terms, they know what is good for them and therefore can study the risk. May not always be true, but this is a general assumption which holds true or broadly true in most instances in a certain phase of evolution. Now, as the market becomes more sophisticated and evolved, the the sachetization of this savings will come into the space also, which means that with smaller unit sizes, people can access these investments. So the specialized investment fund, which the SEBI has approved and launched, is an example of sachetization in some form. It's not as sachet yet, but it's moving in that direction. The minimum threshold size is 10 lakhs. So we see a situation where, or an environment or a scenario where going forward with smaller unit investments, people can access alternates. But for now, alternates are limited to, from an access point of view, from a regulatory point of view, restricted to people who can bring in larger quantum of money. That's one facet of the regulation. The other aspect of regulation is in making sure that these funds have flexibility, because they are addressing a more sophisticated universe of investors. There are lesser limits on where they can invest and in the risk that they can take, with emphasis on disclosure. So the thumb rule in capital markets around the world is, where you take a higher amount of risk, by all means go and take that, but disclose what risk you are taking in advance, so that the investors on the other side know what they are getting into. So transparency and disclosure is one way in which regulation is moving. The third part is the advent of technology, and I would want you to expand on that aspect, because the use of technology is now making regulation more relevant, more effective, faster in every area of regulation. For instance, the information access or the democratization of access today is enabled because of technology. A company that announces results is expected to put it on the exchange site before it goes to the public, and it kind of simultaneously crops up for viewing by everybody in the country. There was a time 25, 30 years back, if you were standing outside the company's door in Bombay or Mumbai, you probably had a head start on the results of a company, and by the time other people in, let's say, smaller towns came to know of it, the money was made or lost. Now, technology has plugged this loophole. So technology is there everywhere in regulation, and the way regulation is structured, the architecture of regulation is framed, the way it is enforced, and the way it is implemented, and the way it is followed. So the regulatory environment has been, also in India, it's been a big success story, because regulators in India, be it SEBI, of course, in capital markets, or the RBI in banks, or insurance regulator, all these regulators have done a fantastic job. Now we have a regulator in the energy markets, and these regulators have done a really good job in keeping the market safe. So we know that during COVID, there was no outage in Indian market, and we've kept the market safe, we've kept the market transparent, we've kept the markets open for people to come in, and the rules have been kept reasonably steady. Maybe you can throw some light on how you see technology shaping this up in years to come, in months and years to come, because things are moving very fast on technology front. So over to you for a take on how I think technology is going to influence this.
The technology has helped a lot in creating this sort of discoverability, analysis, knowledge, and also ability to monitor the portfolios. But as these challenges of the technology being used everywhere, we are now seeing, because of the cyber security attacks and so many issues. So it is very important that we also embed the highest standards of cyber security, and they're all compliant with all SEBI standards. So this is once again another requirement, very much very high requirement to take into account the adoption of technology with right amount of security and safeguards. As you rightly said, on a road, on a highway, if everybody is going at high speed and no safeguards are there, people would bump into each other and everybody would crash. So it's very important that all sorts of safeguards, compliance standards, they are taken into account. We are trying to evolve even our platform. We'll also learn more and more about it as we go along. And then we have seen the advent of agentic AI, which is once again made a lot of things easier from able to analyze and monitor and compare point of view. So we have started relooking at how agentic AI can help this entire industry, all the people in the wealth management space, because they are very busy with their core activities of educating their customers about the financial products, benefits, returns, and managing the portfolio. But they wouldn't. They'll be very challenged about the aspect of being keeping in abreast of this latest technology developments that are every day. Some new developments are taking place. So that's where we thought we will help all of them in adapting to this technology. And technology can be used not only in whatever we spoke about, but it can also help now in automating several aspects of their functioning, whether it is in making their presence felt, or search engine optimization, digital marketing, customer relationship management, portfolio management, both inbound and outbound management as well, and also offering high level of trust to their customers. And you have seen how government and SEBI are also using technology to comprehensively track all the various investments and returns, or audit corporate performance and various types of schemes. So the technology is now becoming all pervasive, and people who are not be able to adapt to this developments that are taking place, they will fall behind and they will drop out. So we are trying to bridge this gap of the requirements of the industry and the expectations of the government and the expectations of the investors and the developments that are taking place globally, by enabling creation of a continuously evolving technology platform. So of course things are very dynamic, and maybe as we go along we will see more and more things happening. The first time I came across the alternate investments and the alternate investment fund space was somewhere around about 10 or 11 years back, when one of my IIM juniors left her very high profile job in a credit rating agency and wanted to start her own alternate investment fund. Why? Because what she said is there is a lot of difference in the way people perceive risk and people offer returns for the risk. For example, the risk may be, the company may be highly credible, but the credit rating agency has given lower rating, and hence they are having to pay much higher return for their loans. So if we are able to, through use of analytics, we are able to correctly judge what is the credit worthiness of these companies or organizations, perhaps there could be a differential wherein you are able to give them at a better get them to get funds at a much lower rate than what market is offering, but that could still be much higher than what you would be paying, what an investor would be expecting. So she wanted to raise funds and create an alternate investment fund wherein she will offer certain interest to the investors. She'll add a good margin and offer it to the companies for their working capital or various other requirements at a lower rate than what they're otherwise getting it from the market. That's got me interested, and they said, oh, I mean, this seems to be a very interesting business model. So that's because a lot of the risk was still not discovered. A lot of it is hidden under people who are knowledgeable, who are able to assess better, people who are having a lot of exposure to all these capital markets, organizations, how they work, how they're able to assess. They're able to extract this differential, right? So then I went and found out that there are different types of alternate investments funds that government has announced. There is category 1, category 2, category 3. Category 1 being those, they could be smaller ticket, but more of the funds invested could be more oriented towards social causes, or helping smaller companies, or letting smaller ticket size investors also participate. Well, category 2, which is now perhaps contributing to about 75% of the market, so they are mostly into venture capital funds and venture capital loans, etc. And there is also another very high risk category for people who are having very high capability to taking risk. That is category 3, which covers hedge funds. So globally, the entire industry started getting categorized into these 3 different types of alternate investment funds. And in India, government has said every angel fund, every venture capital fund, or any fund which is interested in investing in either startups or any complex structured products should fall within this gamut of regulation that government has created. Then we found thousands and thousands of alternate investments funds started being launched by even traditional wealth management companies as well. But while this industry is growing, there is also another segment of fractional ownership properties of real estate, because real estate prices started growing up a lot. Several companies came up offering fractional ownership of properties, but again they were not regulated. They were going through the typical company ROC route, wherein they would launch a partnership company and divide the asset into 200 parts, and then offer the whatever rentals or whatever capital appreciation in proportion to the investment of all the investors. But that is actually not foolproof, because the management of the company still rests with the people who launch that particular asset, and they could fold up anytime, or they declare very high costs and losses for the investors, and they say we don't have anything to distribute. So a lot of people got cheated. So that's where government stepped in, and he said, okay, got all those things also into AIF categories, or they said that these things should fall under REITs or InvITs, this type of fractional ownership company. So now what is happening is you have several funds offering huge number of schemes and variety of schemes across this fractional ownership and investment in startups and investment in structured instruments or even corporate bonds, wherein once again there is a risk reward ratio associated with corporate bonds, wherein everything has to be credit rated before being offered, right? Whether it is CARE or CRISIL or any of them. But again, there is a problem of people not investing, people mostly being misled about the fixed aspect of the return rather than the risk that is inherent in that particular asset. For example, our investment opportunity. We have certain companies openly announcing, saying that you can get 11%, 12%, 13% interest by investing in such assets, while traditionally you get 6 to 7% fixed deposit, making it look very attractive. But they are hiding the risk part of it, and they are talking more and more about the return part of it. So that's where we felt that it is important for us to offer to a certain amount of knowledge to all the investors, both from the point of view of discoverability of the various opportunities that exist in this alternate investment space, whether it is pre-IPOs, corporate bonds, or whether it is different types of alternate investment funds, or any types of other investment opportunities. Maybe in due course, as more and more investment opportunities come about in this space, we should be having a platform that can scale up to to accommodate those opportunities as well, and then offer this knowledge to the potential investors so that they are able to assess the risk and reward in one place while getting exposed to all possible opportunities. And depending on the risk profile or appetite, they could select and then perhaps then approach the company that launched this asset and then invest in that. So that's where we felt that technologies only can enable this sort of intermediation, wherein the investors can then choose from this huge universe of alternate investments. At the same time, also invest with open eyes, because they need to understand the risk that is inherent. And then we found out that while we are creating this entire platform and leveraging technology to offer this sort of a discovery marketplace, that also has the element of analysis of each and every instrument from all angles, so that investors get a bird's eye view of the risk that is embedded and returns that they could expect, and the track records of from various angles. That's where we felt that we thought it could be a cakewalk and we can get investors to participate in this and learn more. But what we found was that there is another important segment of this entire industry, that is the wealth managers as well as the independent financial advisors, who are normally the conduit for all these investments. So the investors normally would not invest directly. They have to go through these wealth managers and the independent financial advisors. And without they being part of this entire thing, there is no point in creating platforms. They won't even bother about it, the normal investors. So that's where maybe through our relationship, we could get a few of the HNIs to take a look at it. So then we started focusing on the pain points of the wealth managers and the industry professionals and the participants in this industry. And several AIFs who are coming about every day, passing different exams, wanting to start their business. We find that for them also, the knowledge of the traditional instruments, mutual funds, whether it is insurance or shares or stocks, portfolio management, all these things is very huge, available. They are able to, and there are structured products around it. so that they can quickly configure something and offer it and monitor the portfolio. But as far as the alternate investment category is concerned, there's neither not much of information available, analysis available, and they need to take a lot of pain to educate the investors to buy them. And they won't do it because they would invest their time and effort wherever they could get a easier return, right? So they were more interested in promoting all the products that are already readily available and suggesting them, or investors would ask. And only if one or two odd investors ask about this alternate investment opportunity, they would do some research to explain to them, but they find it difficult to sell because of the ticket size, durability, unknown risk, etc. They won't bother about it. So that's where we found that this entire industry is coming about, but the environment is not so conducive for its growth. So we thought we should there is opportunity play a big role, and also help the SEBI and the government and the investor community, wealth managers, and everyone, and investors as such, to be able to take advantage of this growing domain, so that the demand side also is benefited a lot, apart from the supply side. So then we started building looking at all the available technology platforms, and started creating this comprehensive technology platform that could potentially help this entire wealth managers, IFAs, etc., to be able to discover all the products available, easily understand, explain the same, the risk reward ratio to their investors, and embed them into the traditional portfolio management scenarios, so that if anybody were to invest in these things also, the returns on that also, the current status of the value of the returns as per the last discovered value, that also could be offered, so that easy for them to offer it to their investors, so that they can start marketing it with more confidence and more knowledge. So actually, as you rightly said, difficult times also bring about opportunities. I strongly believe the situation the world is going through is very short term and temporary in nature, because people say either if situation worsens from here, either the world has to go. Everybody has to die because of some atom bomb, or it has to recover from here. And I strongly believe we are not going to, all of us, going to die of atom bomb. Definitely, situation is going to reverse. Matter of 1 month or maybe less or little bit more. And so it brings in a lot of opportunities, and the future is going, once we recover from here, it's going to be very dynamic, very fast, very progressive, and very remunerative for the people who come through this and invest. But by that time, the systems, everything has to fall in place, and technology platforms also have to evolve. Governments also will have to buck up and get all their act in place. So with a lot of hope, we are planning to push through all these difficult situations and better our platforms, offer better solutions to the customers. And we will cover those things in the future chapter. We request everybody to watch out for more episodes from our FlexiPlops channel to learn about the developments that are taking place and also what we are doing about it. Thank you.